In 2008, the world watched the U.S. financial system crumble under the weight of its own blind confidence. Behind the scenes, risky loans, complex debt products, and unchecked greed pushed the economy to the brink, costing millions their homes, jobs, and savings. But while most people suffered, a few saw the disaster coming and turned the meltdown into massive profits. In this video, we break down how America's housing bubble burst, why the system failed so catastrophically, and the surprising winners who benefited from one of the biggest financial collapses in history. Imagine the U.S. between 2003 and 2006. The nation was recovering from the shock of 9/11. To revive the economy, the Federal Reserve, Fed, slashed interest rates to historic lows. Money became cheap. So cheap that families could sign a few papers and be handed the keys to their dream home. Americans at the time held one belief as almost absolute truth. Housing is the safest asset. Home prices will always go up. When a belief is absolute, people stop checking for risk, and that's when the crisis began. It was a period of cheap money, banks aggressively pushing loans, and everyone chasing the American dream. It was a time when a taxi driver owned 2 investment properties. A supermarket cashier could easily secure a $300,000 loan. Subprime borrowers, those with low income, poor credit history, and high default risk, were still approved for mortgages. It was also a time when real estate agents drove sports cars, lived in mansions, and behaved like millionaires. The entire country felt like one massive American dream festival where everyone was drunk on success because home prices were surging weekly, monthly, as if they would never stop. No one asked, is income keeping pace? Can borrowers actually afford to pay this back? When will housing prices turn? Where is the risk? Because, at the time, the answers simply didn't matter. The most important thing was rising home prices. When the vast majority believe the market will only go up, risk ceases to exist. Banks famously offered a notorious type of loan, the ninja loan. No income, no job, no assets, and still you could get a loan. One broker recalled, "I met a guy who worked part-time at a pizza place, earning $1,200 a month. I processed his application for a $450,000 home loan. The system approved it instantly. Even I was scared." But fear was overshadowed by commission. The broker got paid once the deal closed. Whether the borrower could repay the loan, that was between the borrower and the bank was convinced that rising home prices would save everyone. The most dangerous part wasn't the reckless borrowers. It was the even more reckless banks. They took all these loans, good and bad mixed together, put them into a blending machine, and packaged them as financial products called MBS and CDO. MBS. Simply put, many individual mortgages were pooled together into a basket and sold as investment products, securities. Investors who bought MBS received cash flow from the homeowner's mortgage payments. While this sounds safe, when borrowers failed to make payments, the MBS would drop sharply in value, and this was part of the reason the system collapsed in 2008. CDO, Collateralized Debt Obligation. CDOs were like the upgraded version of MBS. Banks bundled multiple MBS packages, added other types of debt, credit card debt, business loans, etc., mixed it all up, and then sliced it into different risk levels, tranches. The top tranche was labeled AAA, the safest, even if it was full of bad debt. CDOs were Wall Street's most sophisticated way of hiding risk. The banks then sold these MBSs and CDOs to global investors. The ridiculous reality. The more complex the product and the longer the description, the more buyers believed it was safe. To cement this perfect confidence, credit rating agencies stamped them with the AAA label, the highest safety rating. A product full of toxic debt had been transformed into a premium investment commodity. It was all based on the single belief: house prices cannot fall. Lehman Brothers, at the time a symbol of Wall Street, operated with leverage up to 30 to 1. This meant for every $1 of their own capital, Lehman borrowed $30 for investment. A mere 3–4% drop in asset values was enough to wipe out their capital and trigger a liquidity crisis. The entire financial system was similarly leveraged, yet no one worried. The prevailing faith was, house prices will always rise. The whole system is too big to fail. The bitter irony is that the word impossible in finance often marks the beginning of a tragedy. Michael Burry, an eccentric doctor, a self-taught investor who preferred solitude, sat alone in his small office late at night, meticulously going through the mortgage files of tens of thousands of American homeowners. He wasn't just skimming. He read every line of income, every debt obligation, and, critically, the details of the adjustable rate mortgages, ARMs. He then realized a horrifying truth that the crowd was ignoring. When interest rates reset, millions of borrowers won't be able to afford their payments. They would default. And when they defaulted, the MBS packages that Wall Street had labeled AAA would explode like fireworks. Burry made a daring bet. He shorted the housing market. He went to major banks and asked them to sell him credit default swaps. A CDS is essentially an insurance policy that investors buy to protect or bet on when a loan, bond, or MBS defaults or drops sharply in value. The banks thought Burry was insane. They laughed behind his back. This guy doesn't understand the market. This doctor thinks he's smarter than all of Wall Street? Let him buy it. We'll collect the regular premium. Some investors were so angry they pulled their money out of his fund. They believed Burry's bet was a sure loser. In reality, they were selling him insurance on the very bomb they had built. What they didn't expect? The bomb actually went off. As millions of homeowners started defaulting, MBS value plummeted, CDOs followed suit, and the price of CDS skyrocketed. The banks had to pay out billions. Burry's fund earned massive profits, and those who once mocked him were silenced. Beyond Michael Burry, a handful of outspoken investors and small hedge funds like Cornwall Capital, also documented in The Big Short, also recognized the massive debt bomb that the rest of America was determined to ignore. These investors, each operating from a different angle, all reached the same conclusion. MBS and CDOs are going to collapse, and when they do, a golden opportunity will appear. They bought credit default swaps, betting on the collapse the crowd deemed impossible. That decision led them to be ridiculed and called crazy until the bubble truly burst and the value of their credit default swaps soared tens or hundreds of times over. The result? They made a fortune, not through luck, but by daring to believe the facts and daring to bet against the crowd. Between 2006 and 2007, home prices started to drop. Initially, it was just a small decline, maybe 1–2%. It didn't seem alarming. But with the colossal leverage in the financial system, this small shift was like lighting a fuse. Subprime borrowers began to default on their loans. Interest rates started to rise. MBS packages plummeted in value. Banks lost liquidity. Financial institutions scrambled to sell assets. The entire system entered a death spiral. Banks raced toward failure. The first to fall was Bear Stearns, one of Wall Street's oldest and most prestigious investment banks. When clients made a massive run on the bank, Bear Stearns lasted barely 1 week. In March 2008, it was forced into a fire sale to JP Morgan Chase for $2 per share, a price close to zero. Next came Washington Mutual, the largest savings and loan bank in the U.S. WAMU once boasted over 2,200 branches and nearly $300 billion in assets. But as subprime defaults escalated, WAMU sank into a sea of bad debt. In September 2008, it was seized by U.S. regulators, the largest bank failure in American history. And then came the name that shocked the world, Lehman Brothers, the 158-year-old icon of Wall Street. On September 15, 2008, when Lehman declared bankruptcy, the market nearly stopped dead. No one believed that a financial pillar as large as Lehman could actually collapse. But once confidence was gone, no one dared to lend to Lehman, and no bailout was large enough to fill the multi-billion-dollar holes in its balance sheet. The fall of the Lehman Tower acted like a giant snowball rolling down a mountain, dragging down investment funds, connected banks, insurance companies, and the entire global financial system. The United States plunged into chaos. What was thought to be impossible had occurred in just a few short months. Millions of homes were lost. Once bustling neighborhoods turned into rows of abandoned houses. Lawns were overgrown, and for sale and foreclosure signs dotted every street corner. Families who had lived in their homes for decades were forced to move out in tears, unable to meet the skyrocketing payments when their adjustable interest rates reset. Businesses failed en masse. From small companies to well-known corporations, all faced a severe working capital shortage because banks had frozen credit. The financial system lost all trust. No bank dared to lend to another. Credit, the bloodstream of the economy, was choked off, leading to the demise of thousands of businesses. The U.S. stock market collapsed, dropping over 50%. The three most important U.S. indices experienced a dramatic freefall. The S&P 500 plummeted 57%, from 1565 on October 9, 2007 to 676 on March 9, 2009. The Dow Jones dropped 54%, from 14,164 to 6,547. The Nasdaq Composite lost over 55% of its value. These numbers represented more than just index drops. They signified the evaporation of trillions of dollars in wealth, the disappearance of workers' retirement funds, and the lifelong savings of millions of families wiped out by the financial vortex. The 2008 crisis did not stop at the U.S. border. It spread rapidly in a domino effect because the entire global financial system was tightly integrated with Wall Street. Europe plunges into banking crisis. UBS, Switzerland, suffered tens of billions of dollars in losses due to toxic MBS. Royal Bank of Scotland, RBS, the UK's largest bank, faced a liquidity crisis, forcing the British government to inject £45 billion for a bailout. Iceland saw its entire banking system collapse, forcing the nation to declare near-sovereign default. Across many European countries, citizens lined up outside banks to withdraw their cash, fearing their banks would fail overnight. Emerging markets panic. Stock markets in countries from China and South Korea to Brazil and India all plummeted sharply. Foreign investment capital fled emerging markets, creating a dual crisis. Currencies depreciated significantly, interest rates spiked, and businesses struggled to access capital. The global economy enters deep recession. In 2009, global GDP shrank for the first time since World War II. Tens of millions of people lost their jobs worldwide. International trade stalled. Investor confidence crumbled. A crisis is never a natural event. It is the result of greed, delusion, and the lies the entire system tells itself every day. A century before 2008, the world had already seen very similar disasters. The Dutch tulip mania, 1637. People believed a single tulip bulb could be worth an entire house. Everyone bought because they feared missing out if prices kept rising. Prices soared 50x in a short time, then collapsed to zero in weeks. Lesson: FOMO is always more dangerous than actual risk. The South Sea Bubble, UK, 1720. All of Britain poured money into the South Sea Company, calling it a money-printing machine. Parliament members, nobility, and even the king participated. Prices multiplied tenfold. Then the bubble burst. Lesson: when people believe the government is involved so it must be safe, disaster is usually imminent. The Great Depression, 1929. Wall Street at the time believed stocks only go up. Everyone was borrowing money, margin, to buy shares. When prices dropped 10%, there was a panic selling. The market collapsed. The U.S. economy was paralyzed for a decade. Lesson: leverage plus FOMO equals catastrophe. The dot-com bubble, 2000. With the birth of the internet, everyone thought any tech company is gold. P/E ratios were meaningless. Negative profits didn't matter. All that mattered was having a .com suffix. Stock prices exploded, then fell 80–90%. Financial crises never happen in silence. They always generate signals, sometimes so small the crowd ignores them, but clear enough for the sober observer to see. Michael Burry saw it using an Excel spreadsheet. Steve Eisman saw it in the strange attitude of bank traders. Tulip speculators in 1637 saw the absurdity but chose to ignore it. Dot-com investors in 2000 saw the ridiculous valuations, but still gave in to FOMO. So, what are the classic golden signals of every financial bubble? Asset prices outpace true value creation. This is the hallmark of every bubble. Tulip prices jumped 50x in months. Dot-com stocks surged despite zero or negative revenue. U.S. real estate skyrocketed while average income stagnated. When asset prices detach from their ability to generate real cash flow, the market is building a castle in the sky. Key question: is this asset rising because its value increased or because the crowd is pushing the price? If you can't answer, high risk. Debt grows faster than income. Leverage spikes. Leverage is a double-edged sword. History shows that every time debt swells, it poses a danger. In 1929, U.S. investors were buying stocks on margin. In 2008, U.S. subprime borrowers were taking out loans for homes. In 2015, Chinese investors were borrowing to speculate on stocks. In 2021, in many countries, people took out consumer loans to buy crypto. When people borrow to speculate instead of to produce, the market is a ticking time bomb. The emergence of abnormally complex financial products. The hottest markets are often the most innovative ones. In 1980s Japan, there were absurdly complex real estate contracts. The year 2000 saw hundreds of futuristic dot-com funds. By 2008, the market was flooded with mortgage-backed securities, collateralized debt obligation, and synthetic collateralized debt obligation. A simple rule: if a financial product requires 10 minutes of explanation to justify why it is safe, it is not safe. Widespread FOMO, fear of missing out. This is the primary fuel behind every bubble. In 1637, buy tulips now, or they'll be more expensive tomorrow. In 2000, buy tech stocks, or you'll be left behind. In 2008, buy a house today, or the price will jump in 3 months. And more recently, buy crypto or NFTs now, or you'll miss your chance to get rich. When the fear of missing out becomes stronger than the fear of losing money, a bubble is already forming. The irrational belief: this asset cannot fall. Every financial bubble shares this belief. Tulip mania: this flower is unique, its price can't drop. The Japanese asset price bubble in 1980s: land in Tokyo is rarer than gold. The dot-com bubble in 2000: the internet will change the world, so tech stocks must keep rising. The 2008 financial crisis: home prices have never fallen nationwide. Blind confidence is the root cause of every collapse. Macroeconomic signals start to diverge. Some early warning signs include a gradual decline in real estate transaction volumes, sudden reversal and rise in interest rates, an increase in non-performing loans or bad debt, abnormal volatility in bond yields, small businesses struggling to access capital, capital withdrawal from the market, while asset prices still rise. This is when the bubble's energy starts to deplete. Ordinary people make money too easily. This is one of the most classic warning signs in finance. In every financial bubble, there is a moment when taxi drivers boast about their stock portfolios, office workers discuss land speculation, non-financial professionals talk about CDOs, live stream sellers hype coins as going to the moon. When making money from investing becomes easier than making money from labor, be cautious. That's the smell of a crisis.
Apathy to risk and the belief in a government bailout. In 1720, the South Sea bubble burst partly because people believed the British government won't let the market fail. In 2008, Wall Street believed the Fed will save every major bank. When the market believes that risk will be rescued, the risk only grows larger.
No crisis is ever a surprise. Only the investors fail to see the signals. Every bubble over the past 400 years shares the same template. Assets rise too fast. Leverage increases. Risk is deliberately obscured. The crowd succumbs to FOMO, the irrational belief it can't go down. Those who understand the pattern avoid the damage. The truly excellent find opportunity in the chaos. And that is why financial literacy, even the basics, is so invaluable. It empowers everyone to protect their family, their business, and their assets against volatility like 2008 or the crises that are still yet to come.